if we're up 25% on inflation, there's still a bunch of currency yet to be accounted for through inflation. So the inflation isn't over with. Slowing economy, resurgent inflation, massive deficit. Now let's raise taxes. Oh yeah, this can't miss. Hi, this is Mike Maloney with an update on the economy and where it could be headed sometime in the very near future. I want to start with this chart that was posted that shows the stock market priced in ounces of gold. I've been doing this for years, and I've shown this chart before. Now, a couple of the things that the person that posted it doesn't say here. The Dow 30 started, I believe, in 1928. And before that, it was like the Dow 23 or something. And then it was the Dow 18. And then they had to use other indices to try and make this up. But this uptrend is true economic growth during the classical gold standard. This is real economic growth that is happening. And the industrial age and coming out of serfdom, before the U.S., before 1776. So this goes back to 1800. There really wasn't much. The data back here is very sketchy. The data after the Civil War gets a little bit better. But there is sort of an equilibrium that you can see across here of 4 or 5 ounces of gold seems to be an equilibrium that we bounce above and below. But what he's saying is that the biggest scam we've ever fell for was believing we needed a central bank to lower volatility in the financial markets. And he's got 1913 here. Now, 1913 was when the Federal Reserve Act was passed. That isn't when the Federal Reserve went into business. They opened their doors for business in November of 1914, just to be accurate here. And so they have been manipulating the US dollar and the currency supply ever since. This is when we left money and started creating currency. And for World War I, 1913, that should ring a bell when it comes to world wars. So this is coincident with the outbreak of World War I. And then instead of gold being our base currency and all dollars that are, treasury notes being fully backed by gold, we used gold and U.S. Treasury bonds as our base currency. And the Federal Reserve notes that were replacing the Treasury notes had to be 40% backed by gold. And so they were able to increase the currency supply for World War I, and that ended up as a huge boom called the Roaring Twenties that ended in 1929. And so what you see here, this is the stock market priced in gold, but I want to point something out that's going to be very, very important here. Gold was $20.67 an ounce, so the dollar was worth 1/20th of an ounce of gold until 1934, where they allowed gold to exchange rates to float on like every day. Let it float, repeg. Let it float, repeg. And for a month, the free markets and the will of the global public they devalued the dollar significantly. And the price of gold rose to $35 an ounce, where, once again, we had enough gold to where we could have gone back on a pure gold standard that was fully backed, but we didn't. So gold basically rose until it covered the currency supply, but it was really the dollar falling. But then it was fixed again. And so what you're seeing here is only the stock market moving, not gold. And then gold changes right in here. But this, again, is only the stock market moving. And then August 15th of 71, Nixon closes the gold window. And this is basically, there was a big pullback in the stock market in 74, and gold went the opposite direction. And let me see. Gold was illegal for Americans to own until the first day of 1975. And so but mostly the Dow Jones Industrial Average bumped its head on 1,000 points in 1966, and it tried to break that 1,000 barrier several times, and it wasn't successful until 1982. And so for those years, 66 to 82, it just went sideways. So now we're looking at the at this at stocks being fixed up until here, and this is all gold moving. And then after 1982, what we're looking at is stocks and gold both moving, a lot of times in opposite directions. So we've got 18 ounces of gold, 28 ounces of gold, and 45 ounces of gold as the stock market bubbles. This is basically another measurement. It's one of, if you look at chapter 5 in my book, The Great Gold and Silver Rush, I use every possible measurement that there is to absolutely prove beyond a shadow of a doubt that the stock markets are in this whole century. They have been in a bubble that is just out of whack with the entire planet and with all of history. And then, so from 18 down to just 2 ounces of gold as the price of the Dow. In other words, the points on the Dow were twice, where it was double what the price of gold was. And here, 28, and this was actually 1 ounce of gold. This is obviously monthly data, not daily data. But there was a day, the intraday price on the Chicago Mercantile Exchange was $873 per ounce. And at that moment, the Dow Jones Industrial Average was 873 points, 1-to-1 ratio, up to 45. And here it's down at about 16. However, this ends in 2020. This is a very old chart that somebody put together. So I've updated it. And we're still at about, it ended like right about here, I guess, or here. And it's still at about the same point, which means that if it goes back, I believe, if you look at this first chart, there's this trend line at the bottom of this increased volatility. And I don't really believe in this green uptrend line. I think that a lot of this is because of the sparse data and the fact that this is not the Dow. This is a bunch of different exchanges that they're looking at and trying to paste together. And so, but it is interesting, gold standard era, fiat currency era, and how everything has just been out of control since the Federal Reserve has been put in charge of our monetary system. But my point is, if you take that 1-to-1 ratio and you redraw this trend line, you end up today down at somewhere near a half ounce of gold, equaling the potential, if it stays within this megaphone. And so we could have somewhere between 16 and 32 times the number of shares of stock that you can buy in the future for each ounce of gold. But basically, I just wanted to show you that this is another proof that we're in a bubble. So what could pop that stock market bubble and cause a gigantic recession or even a depression? Well, one of the things is just psychology. This is 2024. This is the 1987 stock market crash. And you see the stock market sort of going sideways, a big run up, a consolidation, another big run up, and then this crash. And here, stock market sort of going sideways, a run up, consolidation, a big run up, and another, it's pulling back. This is saying that you are here. Now, what I find interesting is one of the theories of what caused this crash was investors getting spooked by people back in 1987 doing the exact same thing. It was 1987 compared to 1929, and it looked eerily similar, spooking a lot of investors. That was one of the theories that used to be on Wikipedia. I don't know if it is anymore. Wikipedia keeps on changing. But it's interesting, these echoes from the past. So what lies in our near future? I don't know. But if 87 was a repeat of 29, then 2024, if it's a repeat of 87, that's also a repeat of 1929. You might want to take a look at my video about the 1929 stock market crash and the Great Depression. And so moving on, what else could cause the bubble, all of the bubbles to pop? And, we've got so many bubbles that this time around, when the financial calamity hits us, when this train coming down tracks that we are tied to, when it slams into us, what is going to be the scale of the consequences of the Federal Reserve and the world central banks pushing us into all of these gigantic bubbles? What else could trigger the next financial collapse? Bank failures begin again. Philly's Republic First was seized by the FDIC. Now, first of all, I find it interesting that it's Republic First, and the last big bank failure in the U.S. was First Republic. That's just sort of a weird twist. But banks fail all the time, and they're usually wound down. When they're seized by the FDIC, that means there's some sort of emergency going on. Did it have to do, I haven't, this article is a week old, and I haven't read it recently, so I don't know if this was because of exposure to the commercial real estate market or not. But there are a lot of banks out there that are really hurting right now, and the Federal Reserve is trying to figure out, well, how do we get them all through this so they don't have to mark this to market? They're keeping all of this debt on these loans on their books at full value, when the value of the underlying collateral has fallen to almost nothing. As far as the banks don't want to be rolling over the mortgages on all of this commercial property that's got these high vacancy rates that have been here since the lockdowns. Anyway, what else could pop the bubble? Well, here's new home supply in the U.S. rises to the highest level since 2008. And, I think I forgot to put I'll see if it's in this presentation or not. But recently, jobs in construction have just fallen off of a cliff. This is one of the reasons why, is we have this glut of new one-family homes for sale in the United States. This is the inventory that's on the market. This was 2007, 2006, and 7, the subprime fiasco and the global financial crisis of 2008, and the subsequent reduction, the sale of all of these homes. So look at the level that we're at right now. It's the highest level except for the real estate crisis. So are we actually in another real estate crisis? Well, I was talking with Kenny McElroy, and he is one of the real estate gurus out there recently. And, I couldn't find the data on it on the Federal Reserve, but existing single family homes, there's actually a shortage of now. So this is a glut of new homes. But construction, existing homes, you don't construct. And so this has just fallen off of a cliff because of this glut. So what could pop that bubble? Well, this is the median home price compared to the median household income ratio. Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. What could pop that bubble? Well, this is the median home price compared to the median household income ratio. And throughout history, people can only afford a certain amount of their income to put a roof over their heads. That is just simple, fundamental economics. If you're paying too much for your house, you don't have enough left over for all the other things you need to live. And, when I was talking with Todd Sachs in an interview that when I was on his channel, Sachs Realty, he was saying that there's some areas that people are paying 8.5 times their income for the price of a home. Now, there's a chart that's even more important than this. If you take this times the mortgage rates, which, when the Fed changed the Fed funds rate from basically 0 to 5.25, mortgage rates went through the roof with it. So not only are they paying 7.5 times on the national average here, 7.5 times the or 7.5 years of their income, their 100% of their income for 7.5 years for that house, they're paying that as in mortgage payments that are far, far higher. So you take this times the change in mortgage payments, and you end up with something that is just in the stratosphere. And this is one of the things that will be popping the bubbles that we are in. So what else could pop this bubble? Biden calls for a record 44.6%. So it's not Biden, it's his administration. They're calling for a 44.6% capital gains tax rate. And so here is the chart that's lower down in that article that shows that this is a historic capital gains rate. Now, when you have some extra cash, what are your choices? Well, you can keep it in cash. You can save it, try and get some interest at a bank by depositing it in a savings account, or you can invest it, whether it's in bonds or stocks or whatever that goes through the stock markets. And this, you saw the picture of 1987 to 2024. And if you read chapter 5 of The Great Gold and Silver Rush of the 21st Century, I use the Buffett indicator. And I found this indicator that is the Buffett indicator globally for 17 advanced economies going back into the mid 1800s. I think 1860 is how far it goes back. And it shows that we have just been in this bubble century. Since the year 2000, everything went crazy. So we're in these bubbles. Well, if you've got a choice, spend it now, save it, or invest it, and you're paying this type of penalty for investing, you're much more encouraged to spend and get that instant gratification instead of delayed gratification, suffering now for a brighter, potentially brighter future by investing. And so 44.6%, I believe, is the rate that they are proposing, the highest rate in history. This is pretty much guaranteed to slow the amount of investing that is done in the stock market. It was 1982 that the Dow finally busted through 1,000 points. And, it was lower tax rates that sort of encouraged all of the investing, lower capital gains tax rates. Well, you know what? In economics, there are certain things that are laws, and there are certain things that are theories. And a while ago, Arthur Laffer came up with a theory that I believe is a law. Now, you can say to yourself, well, gravity is just a theory, and I think it's flexible. So if I jump off a 10-story building, I'm going to be fine. And, I believe that this is violating fundamental laws of economics. It's like jumping off of a 10-story building and just believing that you're going to be okay. And this is that law. Now, if we look at this, you've got the tax rate, and as you increase the tax rate, you increase tax revenues to the government. But Arthur Laffer theorized that there is an area where that if the tax rate is too high, you actually slow down. You don't increase, but you decrease the amount of tax revenues going to the government. Why? Because people are less likely to work as hard if you're taking so much from them. And the proof that this is an actual law lies right here. If you raise the tax rate to 100%, and you take everything that everybody has earned, then everybody dies. There is no economy and there is no government to receive any tax revenue. And so that the death of all of humanity is the absolute proof that this is a law, not a theory. And what we are trying to do is violate a fundamental law of economics. But most economists agree that the Laffer curve is actually shifted, tilted. And so we have here, and I've got more evidence of this later, but we have here a revenue maximizing point. And this is always what the government is trying to hit, but they actually are doing this because inflation is a tax that we all pay. It's revenue that goes to the government for creating new currency and diluting the currency supply and steal. It's a tax on us. So they're trying to hit this revenue maximizing point, but they're actually going past it and slowing down the economy. Now, I want you to look at this other thing that economists point out, growth maximizing point. Now, many times I've gone over the Economic Freedom of the World Index, and I show that the richest countries have the lowest poverty rates. The poor live better in the richest countries than the poor in the medium countries and the poorest countries. It's got lower child mortality, lower child labor rates. It's everybody in the richest countries. It's got the longest lifespans. So the population is the longest lived, and the poorer countries are, the shorter your lifespan is. So I've said many times that we actually live in a modern dark age, but you can't prove it because we have no basis of comparison. We don't have another Earth somewhere that didn't do all of these things that we have done to put us into this modern dark age. But if you go back a few hundred years and you were trying to hit this point where you have a society where government is limited, and what it's doing is creating a fair playing field with very fair laws, legal system, and property rights. That's a very important thing in society. But government wants to politicians get elected by promising that they're going to do everything for you. And they keep on adding things. People say, well, how would we have roads if we didn't have government? Well, if roads are the thing that government is supposed to do, then let them do it well and stop trying to do everything else. Look at the condition of our roads. They're doing if that's the thing that you think that we have to have government for, then they should at least be providing decent roads, and you shouldn't be spending half of your day in traffic. So this is the growth maximizing point. If they were hitting this, and we know that the wealthier a society is, the longer you live, and the happier. Also, the happiness index in poor countries and countries where the government is doing everything to redistribute all the wealth and make everybody equal. In those countries, people are not nearly as happy as the free market countries. And so if we were doing this compounded year after year after year of this maximum growth, where would we be now? I have said, we would probably be living on the average 120 years and maybe being able to vacation on the moon if we wish. We should be there. Government puts handcuffs on us. They slow us down. It's too much government is this maximizing revenue and squeezing as much as they can out of us without slowing down the economy, but then doing deficit spending puts us over on this side of this equation. Now I want to go over to marginal tax rates. So you saw the capital gain rates. This is income tax. And this is the top tax rate. This is the bottom tax rate. During World War II, if you started a company and you became a massive employer, employing hundreds of people, and you became wealthy because of this, for every dollar you earned, the government allowed you to keep 6 cents. Yes, we had a top tax rate of 94%. And then they lowered it to 91% all the way to the mid-60s. And what does that do? Well, it causes anybody that is truly driving the economy, all of the people that create big businesses and create all of the jobs, they do nothing but try and figure out how do they get to keep some of what they've earned. And here you see this 94% tax rate. And I want to point out that in the 90s and 2000, you had like a 39% tax rate here. So 94, 91, and 39. And then you've got the lowest tax rates. But one thing that this chart also shows, and the chart of capital gains, politicians believe that everything that you make, everything that you earned belongs to them, and they get to change the rules at a whim. At any moment, they can take whatever they feel like from you and magnanimously allow you to keep a certain portion of whatever you've worked hard for and made. And so let's take a look at the data here on the Federal Reserve site of how much gross receipts as a percentage of the economy. What percent of the economy flows to the federal government? Well, back during World War II, when the top marginal tax rate was 94%, they got 19.8% of the economy. In the year 2000, when it was 39%, they got 19.756% of the economy. It's almost identical. And so this shows here they allowed the economy to boom. Here they slowed the economy down after World War I with those high tax rates. And this actually fell as they got punished. The government got punished for having these tax rates of 94% and 91%. And here, Reagan did big tax cuts, but he also did big deficit spending. It was during that period where the term deficits don't matter came from. I think it was his vice president then that said that, not Reagan. I'm not sure which, but so we started cutting taxes in this era, but we also did a ton of deficit spending, which comes back to haunt us as an inflation tax. And you saw, the inflation of the 70s and so on was all of the spending of Korea, Vietnam, Johnson's Great Society coming back to haunt us. It was deficit spending. And so this just shows that there is an average of about 17.5% federally. This doesn't include state and local and sales tax. But about 17.5% is all they can squeeze before they start choking off the economy. What else can pop the bubble? Well, G20 proposes a 2% wealth tax. And here's Janet Yellen. Will Biden approve? And then moving on, we've got Janet Yellen, U.S. Treasury Secretary Yellen. I'm concerned about where we're going with the budget, the U.S. deficit. So she's the one that funds the deficit. She's the one that sells the Treasury bills, creates them and sells them. And Sven Heinrich, I just love Sven, and he's saying, Yellen concerned? It's like a bad joke. But what could pop the bubble? Well, yes, that deficit. When you add the deficits together, what do you have? The national debt. This says that it took 220 years for the U.S. debt to reach 11 trillion. Well, I double checked this on the Fed's website, and it was January 2009 that we hit 11 trillion. So this is January 2009. 1776 from that gives you 233 years, not 200. So it took 233 years to spend that, to get into debt, to borrow the first 11 trillion. And it's only taken the last 4 years to borrow another 11 trillion. So that just shows you how disconnected from economic reality all of the politicians are. They're saying, how can we spend this? How can we give you that? How can we do this, this, and this? Whether it's funding foreign wars or whether it's doing some new program in the United States instead of taking care of the roads, and then that deficit spending, when the Federal Reserve buys some of those treasury bonds, which is where all of the base currency comes from, is the Fed buying treasury bonds and mortgage-backed securities. That's basically the bulk of it. And so when they do that, it dilutes the currency supply. There's more base currency in the banks. The banks can then expand bank credit, and we've experienced a 25% inflation since this is January 30th, 2020 to today. A 25% inflation. The 25% unrealized gains tax is already here. So if you invested $100 in something in the year 2000 and you sold it today and you sold it for $125 and you made a 25% capital gain, you've broken even, and you go, whew. But then you have to pay 44.6% tax on that capital gain. So you lost $12. You lost 12% of what you thought was a 25% gain. And this is the M2 currency supply, which includes the bank credit. So this is the vast majority of the currency supply. It is up from January of 2000. It's up 35% right now. And so if we're up 25% on inflation, there's still a bunch of currency yet to be accounted for through inflation. So the inflation isn't over with. And I've been saying this for a long time. It takes a while to work its way through the economy. And we have changes in velocity. So trying to measure all of this is almost impossible. But over the long run, the number of units of currency in a society and the amount of goods and services that are available for it to purchase is what's going to determine the value of that currency over the long run. So speaking about inflation, a Chipotle double steak bowl is now $39 in California. Further down in that article, this guy says, when I was in California for a Nuggets game on Thursday, we stopped at Chipotle. The same double steak bowl I get for $17 in Nevada is now $39 in California. The new minimum wage law is insane. So restaurant workers, the minimum wage has been raised to $20 an hour in California. Not even the rich will be able to afford to eat out anymore. Thank you, Gavin Newsom. He's the governor of California. And I just want to show anybody that doesn't have Chipotle in their state, it's basically a Mexican fast food restaurant where they make production line Mexican food that is served on paper plates with plastic utensils or wrapped in tinfoil. And so Sven, again, he is just great. He wrapped this whole presentation up in just a couple of sentences. Slowing economy, resurgent inflation, massive deficit. Now let's raise taxes. Oh yeah, this can't miss. He's great. And so they print more currency, causing inflation. These two are mutually exclusive. If you used money, we wouldn't have inflation over the long term. We would have short-term inflations with a following deflation that would net out to zero based on changes in velocity. And so they print more currency, causing inflation, so you have to invest in assets, then put a capital gains on those assets so you can never escape inflation. And so I just want to leave you with this. I want to thank you for watching. We'll see you next time.